Good morning, good morning. Nice to see you guys. We'll see if we get a few more people in here. I imagine we will. Nobody likes to not trade, is what I have found. Nobody likes to take a day off. So I imagine we'll see some people in here. So far this morning has been a whole lot of nothing. Hey, good morning, Miss Adriana. Nice to see you in here. I've done more away from my computer than I have at my computer. Good morning, Bob. Nice to have you. Today is Monday, February 17th. Jeffrey, good morning from that bone cold Central Mass. We're a little chilly here too. I think we're in the 30s, which for us might as well be the negative 30s because, you know, Texas. That's okay. It'll be 70 again in a couple days. Yeah, we are 31 and sunny right now. Bob, Jason will get you squared away. Jason will get you squared away. He always does. It's crazy. That guy has forgotten more stuff than I've ever learned regarding tech. So, I even use them. When I was setting up my wife's computer, I was on Skype with Jason. He got on my computer. Everything that I broke over the course of 2 hours trying to get it right, he fixed in 5 minutes. So, good stuff. Guys, today's Monday, February 17th. It is President's Day, which means that if you need a new mattress, today is the perfect day for it. Not necessarily the best day for trading. The markets do shut down early, I believe, 11 Central, 12 Central. Which means that most of the people that are moving the markets are probably on their boats somewhere, or ice fishing if they're up there on the Great Lakes. So I don't know what to expect with the day from a volume standpoint. I don't know what to expect in regards to movement or trade setups. But what I do know is when the volume is lighter, when the volatility is less, adherence to rules tends to be a much better path. Good morning, Marlon. Good morning, Gary. No news to note. 9:30, 10:20. It's yellow. It's low impact. Couple talking heads flapping their gums in there, but nothing that really warrants a prairie dog popping up, seeing what's going on. There is medium impact at 6 p.m. I think most of us are done trading at 6 p.m. Probably making burgers. Can you guys hear me? Give me a Y if you can hear me, please. Let's make sure Gary knows that it's him, not us. All right, and he knows the drill. So if you guys put the Y's in there, and I don't know why, but he seems to be my Discord problem child. Hey, Spice. His Discord hates to give him volume first thing in the morning. I don't know why. I would go to tech and say, Jason, what the heck? We're going to slow roll today, guys. I'm going to tell you right now, I am not going to be in a hurry because I don't imagine I'm going to get a whole lot of charts from you. And that's kind of what the room is. Every morning, we're going to go over the high. Yeah, he had me muted. You and my wife. Every morning, we go over the high probability trend trade, guys. And the layout for class has been consistent for as long as I've taught it. And let me see if I can find this. So every morning, I'm just going to pull up the Trend Trade Simple document here. This is what we're going to talk about. So live 5 days a week, guys. We're going to talk about 3 rules on 2 charts. We're going to talk about the high probability trend trade. We're going to recognize advantages. We're going to go through all those things that I go through every morning. My first hour is always the same. It's designed to lay down that foundation. It is designed to help you recognize advantages. It's time to teach you the rules for the trade that's going to teach you to read your indicators. And that's what the high probability trend trade is. It's a trade that typically wins 70 to 80% of the time. It's a trade that teaches you to read your indicators. And that's such a big part of what we do, is reading our indicators and waiting for advantages. The way this classroom is set up is my first hour will discuss this high probability trend trade in great depth. And you guys are always cordially invited to drop your pictures of any trades you take in that first hour. But I don't go back and review charts in the first hour because I want to lay this foundation. I want you guys to understand these rules because I go back to these rules on every chart that's presented. So if you post in the room and you don't get immediate feedback, guys, that's normal. We go to the second hour so you have something, some frame of reference to go through. If you need immediate feedback, if you have somewhere to be, you've got to go to work, the doctor is expecting you, let me know. I'll always pause and give you that feedback. But our first hour is very much a lecture. It's talking about this high probability trend trade because it is the trade that typically wins 70 to 80% of the time. It is the trade that creates confidence through that memory of success. It's the trade that teaches you to read your indicators, to understand advantages, and then it's throwing those advantages together to create a trade. 90% of your day is reading your indicators. 10% of your day is trading. So we lay this really solid foundation down because once you have it, you're going to understand where the market is likely to continue. This will become entries for your highest probability trend trade and really every other trade that you take. You're going to understand where the market is likely to go. This is going to help you with targets. And then finally, you're going to understand where the market is likely to stop. And these likely to stop areas are what we call termination conditions. And these are the giant red flags with sparklers and stop signs that say this is the point where that trend that you've been trading is most likely to end. Maybe let's not take that next trade. So 90% of your day is going to be waiting for advantages. 10% of your day will be actively trading. So when we talk about the advantages, we're talking about the highest probability trend trade that Nexgen teaches. This is not the only trade. This is the trade that teaches you to see the other trades. And once you can identify momentum and path, these first two advantages that come from rules 1 and 2, it opens the door. It sets you up for more. You're going to begin to recognize patterns that create opportunity outside of this highest probability trend trade. But until you can get these two down, your path of least resistance and your highest chance of success comes from focusing on this one trade until it becomes easy. So each rule in the high probability trend trade creates an advantage. Rule number 1 in white gives you the advantage of momentum in yellow. And rule number 2 in white gives you the advantage of a clear path in yellow. And rule number 3 is specific to the trend trade, and it's going to define your entry, that point where the market is most likely to continue. So I want you guys to go ahead and embrace the idea that a trade isn't a desire to win or a feeling that the market may go up or a hope to make enough money to pay your mortgage. But a trade is momentum plus a clear path plus an entry. So it's the advantages that create the trade. These advantages are found on only 2 charts. You have a large chart and a small chart, and the large chart leads the way. The large chart tells you that it's time to go look for an entry. The large chart will define the direction of the market, identifying which way you should be looking for your rules to be met. The large chart will show you the momentum through rule number 1, making sure that that first advantage is in place. The large chart is going to define your path, the areas that may be problematic, letting you know that you haven't reached an area that's likely to stop forward progress. So the large chart is a very slow moving, it's a broad stroke of a brush, and you'll see these advantages, rules 1 and 2 will be met, and you'll recognize it through the most current bar on that large chart, the first bar on that large chart. Once the rules are in play, and only when the rules are in play, when you have momentum, when your path is clear, you'll turn your attention to a smaller, faster chart. This is a refinement chart. It takes that one bar and shows you all of the inner workings. And that refinement process is how you're going to pinpoint the best of the best area for entry, that point where the market is most likely to continue. By using that refinement chart with those advantages from the large chart, you're going to be able to reduce your risk dramatically. You will be able to increase your profit potential. So rule number 3 is the only rule that happens on the small chart. It's just an entry chart, taking all this great stuff and translating it into a trade. We use these two charts because this is my metaphor, right? Who are you trading with or against, guys? The large crowd, the men and women with the money and the influence to create trends, to react at these areas, to establish momentum. This is your large chart. Your large chart, you should think of it as the large crowd, and your path of least resistance is trading with the people who are in control. Your small chart is a small crowd. It's this little group of people that still has more money than you or I, you or me, excuse me. They still have more influence. They can still create rifts in the matrix, if you will. And they create what we call these pullbacks. Well, 70 to 80% of the time, the small crowd fails. They don't change the direction of the market, and the large crowd takes back over and the trend continues. Rule number 3 is designed to have you pinpointing where their failure is most likely to occur. And by doing so, it lets you know where the market is most likely to continue with the direction and the momentum that's already been established by the large crowd. So 2 charts. Know who you're trading with or against. Hey, good morning, Cav. Good to see you. And guys, this classroom works the same way every day. And it works because it's a very proven path to get to where you want to be, ASAP. We will take an hour to learn the Fibonacci rules and trigger line rules for when it's okay to trade. We will break down each of the rules individually. I'm going to help you identify when the rule is true as well as when the rule is not. I will give you a way to study these rules so that they become second nature sooner than later. And we're going to teach you how to piece them together to create the highest probability trend trade that Nexgen teaches. Our first hour is dedicated to an entry for the high probability trend trade. It is not a complete trading plan. The high probability trend trade is not your only trade. It's the trade that teaches you to see the other trades. You have the ability to simulate, to practice, to get in there, to practice these rules, to take pictures of things, and the most important thing you can do is post your trades in class, guys. Post your chart reads in class. Tell me what you see and why you did what you did. Tell me that you saw momentum. Point out that you believed that you had a clear path. Show me where you entered the market and show me where you exited the market, and get in the habit every time you take a picture, talk about these advantages, because what you're doing is you're creating a correlation between the looks and what they mean to you. So that's what takes us into the second hour of class. Everything that you guys post, starting from 4 a.m. in the morning until about 10:30 Eastern, is going to sit on the shelf until we've learned the rules for when it's okay to trade, and then we're going to go back and you'll get feedback on everything that you post in this room. We will talk about your chart reads. We'll talk about your entries. We'll talk about your exits. We'll talk about everything that you did great and celebrate those victories. And if there were challenges, things that might be taking away your advantages, we'll identify them and we'll talk about how to overcome them. So every time you post in my room, it's a private session in that second half of class. I simplify. I do my best to not make anything complicated. The least amount of moving parts in my world is the easiest thing for me. That's how my brain works. So I try to do the same for you guys. I'm going to hand you a plan before this room is done. It's called the KISS plan. And the KISS plan optimizes your chances of success with the high probability trend trade. Again, it's focused on that best of the best. It also introduces you to a second trade that is dependent on your knowledge from the first trade. So I'm going to give you a simple plan with 2 trades. This is a plan that I've had Nexgen users get funded in those prop firms in their first 30 days following it. And the feedback on the plan is that it typically results when you follow the rules in that 70 to 80% range. But you've got to learn the looks you're going to commit to. You must learn the Fibonacci and trigger looks so that they're easy. And they do become easy. And repetition creates recognition. And again, I encourage you guys, don't look for trades, not as a brand new user. Look for advantages, because advantages create the trade. So keep it simple, keep it focused. And the second path, or the second part to getting to where you want to be, after you're posting all your trades in class, getting that private session, use the spreadsheet that Nexgen gave you when you downloaded the software. When you downloaded your demo, the spreadsheet went into your Nexgen Study Picks folder. I just dropped mine right into the chat box for you. You can download it. But this spreadsheet is where the recognition comes in. The spreadsheet is the repetition that creates that recognition. The spreadsheet is what allows you to recognize the rules being met so that the looks become easy. So your first tab on it is trade tracking. And maybe that should be the last tab. But the trade tracking is every time you take a picture, drop it in the room. Give me the opportunity to give you some feedback. Under the picture section, how to annotate your charts for the best feedback, making sure that you're going back and talking to yourself about what you saw. Did you see momentum? Was your path clear? Did you define your entry area in the correct spot? You can even show me all the way to the finish, and that's what I prefer. Show me your exits as well, because sometimes there's a lot of opportunity to make a lot more money. As you learn to manage these trades, I'll give you all the feedback I have on it. There's 2 links, how to post into your spreadsheet, how to get those pictures in there. And this is really important because you're going to come back and study these. But I believe that the most important part of this page is the feedback section. Guys, I've been reading indicators and teaching people to read indicators for the better part of 5 years. I've made every mistake in the market that you can make, I believe, and I've learned how to fix it. And every time you post in my room, you're going to get a private session giving you everything that you need to grow from that particular trade. So you'll begin to see things that repeat themselves in the feedback section. Sometimes the feedback will be perfect entry, never miss this, make that one a part of your plan, great job, everything is awesome. But as a brand new user, more often than not, and this isn't a negative, this is an awesome part of the learning curve, is you're going to see items repeat, maybe into termination condition. That was my challenge as a brand new user. Maybe your entries are a little early, maybe your exits are a little early. But what happens is the more you see the same thing, that's your pattern, that's your thing. And that's what I'm going to give you a plan to work on so we can eliminate anything that's creating problems for you. So if every morning, I should put this in there, if every morning you take the 3 to 4 minutes that it takes of your day to go back and look at what you did. So this morning, what did you do Friday that worked? And now you're going to focus on repeating that behavior, because that's the behavior that's working, that's bringing profits. And you're going to ask yourself, what didn't work? Well, Mark, I'm not sure what didn't work. Go to your feedback section. Trust me, I'll tell you exactly what didn't work. You'll notice that when you follow rules, when you have these advantages, the trades begin to feel easy. And you'll notice that when you break your rules, especially when you knowingly break your rules, you will feel nervous, guys. These trades feel forced. And when you're breaking rules, when you're ditching advantages in favor of hope, this is where you start moving your stops erratically. This is where you start getting out of great moves when there's no reason to get out of great moves. But this brief historical study each morning, it prepares you for the day. It accelerates the learning. And what you're doing is you're committing the patterns to memory. There's the basic rules tab. Good morning, Miss Jen. Strong triggers. Rule number 1, in green. Clearly defined in pictures and words so that there's a correlation between the two. Weak triggers. The absence of the advantage of momentum, clearly defined in annotated pictures so that you never make this mistake. Clear path. Clearly defined. Termination conditions, not having that advantage, clearly defined. Guys, this is your core. Strong triggers and clear path is your core. It's enough to create a trading plan that's very consistent, very profitable. So know the difference between the two. I'm going to give you a sheet to fill out this portion of the spreadsheet. It's homework, it's work, but if you do it, you'll get to where you want to be faster. The next tab is client trades. This has the high probability trend trade, how you define your entry, both long and short. It has a very mechanical management plan, and that'll be given to you in that KISS plan that I'm going to provide. There's almost 400 pictures of Nexgen users taking those advantages: momentum, path, and entry. I would say 90% of these are winners, but the high probability trend trade is a trade that typically wins 70 to 80% of the time. You're going to see some of that 20 to 30% in here, guys. Truth in advertising. Anything that wins 70 to 80's got to lose 20 to 30. It doesn't mean that the trade was wrong or a mistake was made. It becomes a cost of doing business. And when you begin to learn these patterns, you will learn to accept losses as a normal part of a positive equity curve. So go through and look at these. A lot of you want to be NASDAQ traders. The NASDAQ trades about 10 times faster than crude oil or the S&P. I encourage people, learn on the slower charts first. Know your rules like the back of your hand, because the reaction time that it takes to trade the NASDAQ is fractional compared to what it is on the other two. There's ideas in management, very basic, and then when you can begin to hold for bigger moves or when you should jump ship a little sooner. And then once you're a chart reader, you're going to start to recognize patterns. You're going to see things every day. You're going to see, oh my gosh, I've seen this again and again and again and again. And you'll see in this room people that are creating their own trading plans based on the patterns that they recognize. And that's kind of my hope for each and every one of you, is that you learn to read your indicators and then you build your plan. And that's what the final tab is. The final tab is your personal trade setups. In the beginning, it's going to be the high probability trend trade. Maybe that develops into a momentum trade or an HVA trade. Maybe you find a counter trend trade, whatever. Take 20 pictures of it, 30 pictures of it. Prove that it wins more than it loses. Make it earn a spot in your trading plan. You're going to learn how to manage outside of the basics. Start taking pictures. Start taking the pictures where you get feedback in class on when you could have held more, or maybe when the ride was over, and start taking pictures of those patterns. One of the things about this classroom is you don't have to only post trades. If you see something and have a question, post it in the room. If I'm talking about momentum, this first rule, and you have a momentum question, when you post the picture in the room, say, hey, Mark, this is about momentum. And I will pull up that picture mid-lesson and make sure that we get it. If it is trade feedback, remember that is the second half of rooms. So we're going to learn the rules for when it's okay to trade. We're going to break them down individually. I'm going to give you everything that you need to study them. You guys have the ability to simulate, and for 15 hours live every week, the only thing you have to do to get a private session with me, to get feedback from me, is post a picture in the room. You'll have a plan before you walk away today if you haven't already gotten it, and you're going to begin working on what looks you'll commit to. That's what we're going to talk about all day long, is the looks that you'll commit to. And when I say looks you'll commit to, it means that your rules are met, that your advantages are in play. 90% of your day is waiting for those rules to come into play. 10% of your day will be actively trading because they're there. By the end of the day, you will have everything that you need to be successful with the software. So let's talk about what we're looking at. You've got to know the pieces. You don't have to know how they're programmed. You don't even have to know why they're called what they're called. But you need to know that every chart you look at will have both small triggers and large triggers. Your small triggers are a fast-moving average. They're two solid lines that work together to create the small triggers. The large triggers are just a slow-moving average. They're two dashed lines that work together to create the large triggers. You're going to see large and small triggers on every chart that you open. We're going to use them initially to define momentum through rule number 1. You're going to use them as well to define termination conditions in rule number 2. And you will use them again to define your entries through rule number 3. So know the difference between small and large. Be able to recognize them. Every chart will have areas. Areas have a different role depending on the chart. The large chart leads the way. It defines the areas that are problematic, and it's really just horizontal lines on a large chart. Magenta divergence highs, meaning there was a loss of momentum right at this pivot. Cyan divergence lows, meaning there was a loss of momentum right at this pivot, guys. That's all divergence is a loss of momentum. You're going to see Fibonacci resistance, blue Fibonacci support. You're going to see yellow 1-to-1s, and you're going to see a mid-band, that squiggly moving average that runs through the middle. When it's green, price is above it. It may behave as support. When it's magenta, price is below it. It may behave as resistance, guys. These areas on the large chart will define trouble. These areas on the small chart will define entries. So know which chart you're looking at, and I'm going to teach you how to use them in their intended roles. So we're going to go through 3 rules. If you have a question, interrupt me. If you have a comment, interrupt me. Guys, it's okay. I don't have a time frame. And today's a holiday, which means that we're going to have probably too much time. So if there's anything on your brain, spit it out into the room. Large chart leads the way. Large chart is the large crowd. Large chart has the task of defining direction, momentum, in areas. And all of that comes through the first bar. So on the large chart, we're going to let it define direction first. If the background is green on my large chart, it's going up. If the background is red on my large chart, it's going down. How easy is that? Trend lets you know which direction you'll be looking for rules to be met. I'll be looking for high probability trend trades long. I'll be looking for high probability trend trades short. When you define trend, you're going to use that background color to help you define momentum. In an uptrend, in order to have strong triggers, rule number 1 met, the advantage of momentum. Both your small triggers and your large triggers must also be green. This is your little keep you out of trouble cheat. If the background is green, large and small must be green. If the background is red, large and small must be red. If they're not, if the triggers are different colors from one another, or the triggers are different colors from the background, you don't have rule number 1 met. You're going to be in a holding pattern. But in an uptrend, when your small triggers break up and above the large triggers, when the large triggers are widening, that's a key point, that they're opening up. The space created between small and large lets me know that the odds are favorable for the market to continue up. When the smalls break below the large are widening. The space created, I want you to picture scissors that are opening, ready to cut. This space lets me know that the odds are favorable for the market to continue down. So strong triggers is odds favorable momentum. You're going to see that annotated on charts all day, OFM. When small triggers return to the large triggers, work their way inside of the large triggers, this is weakness. This is weak triggers. And when I have weak triggers, anything can happen up or down. So strong gives the advantage of momentum. Weak tells me anything can happen. You're going to begin to create a correlation between what you see and what it means to you. When I have strong triggers, the trend is most likely to continue. When I have strong triggers, that's the advantage that helps me understand when these key Fibonacci areas have the potential to break. When I have strong triggers, I'm going to look to buy or sell Fibonacci support, Fibonacci resistance on that smaller, faster chart. So between these two areas, the point of separation until the triggers return and give me weakness, every now and then on that large chart, you'll see price break down below the midpoint of the bar. It looks like a tail or a wick. Each one of these tails or wicks are possible long trades. These are pullbacks on a smaller, faster chart. And in a perfect world, they're a pullback to areas inside of triggers defining where the market is most likely to continue. You can use these tails on the large chart historically to go back and study these patterns, but the small chart is going to give you the ability to pinpoint where that tail is most likely to form and use it for an entry. In a downtrend, it's the same thing. From the point where the triggers separate until they return, anytime on a large chart, going back studying this look historically, you see one of those tails or wicks, understand that it was a potential entry, that there could have been a pullback to an area inside of triggers on that look. So I'm going to pull up crude oil here, and it's not doing anything this morning, guys. It's a holiday. Separation means strength. Smalls below the large, and the market pushes down. It breaks an area. Small's above the large, and you can see how the market pushes. Weakness is where that retracement happens. Starting to return is where that market heads up. And guys, weakness, there's a retracement. Strength, there's a push over and over. So I always like to ask, is everybody good? That's rule number one. Can you give me a why? Strong triggers, guys, they lead the way. Strong triggers push a market. Strong triggers can break areas. And God bless them, strong triggers can cover a lot of the mistakes that we make as new users because it's hard to stop a large chart with momentum. But there's things that can, and we call them termination conditions. And a termination condition is that likely to stop area. And when there are none, you're going to have room to your profit targets. And when you have room to your profit targets, we're just going to make it easy to say. We're going to call it a clear path. So defining a termination condition. Termination conditions are those Fibonacci-based indicators on the large chart that may reverse the market. And it's based on a comparison of the area and the T3 trigger strength and location. So those horizontal lines on your large chart, guys, that's where the large crowd, where the men and women making stuff happen, that's where they're most likely to make a decision. That's where the buyers may buy and the sellers may sell. Fights may happen. Reversals can occur. So you're going to use the idea that the large crowd is making decisions at these key areas that you see off in the distance long before the market gets to them. And until the market gets to them, we're going to call them a target. But once those dynamic price bars reach that area, you have to believe that there's a decision-making process about to happen, and you are never privy to the information, and you never know what that reaction is going to be. So when price reaches resistance, dynamic Renko bars trade up and hit Fibonacci resistance, hit a divergence high, hit yellow one-to-ones. The only thing that you have to do is ask yourself, where are my triggers? If your triggers remain below resistance, it's a termination condition. It may create a big untradeable bounce. There may be a fight right there at that key area. Sometimes it just dissects it for an hour. Hey, good morning, K-Dog. And it may reverse the market, meaning that your large triggers go from green to red. If a key area is a termination condition, if price reaches it and your trigger lines remain below, and then it reverses the market, it's what we call a strong top. And a strong top is the precursor to the highest probability trend trade that you can take. And a strong top is rule number one for no less than 3 other trades that are rattling around right off the top of my head. So it's not mandatory for a high probability trend trade, but when your trade happens from a strong top, it's more likely to win. From that strong top, momentum pushes the market down. It begins to slow. Anything can happen. And then price reaches Fibonacci support. When price reaches Fibonacci support, all you need to do is ask yourself, where are my triggers? And if your triggers remain above support, support's a termination condition. It could create a bounce. It could create a fight. It could create a reversal, making it a strong bottom. You'll never know what the reaction is. So rule number 2 says that when rule number 2 is not met, don't trade into the area. Wait for the reaction. If it doesn't bounce, fight, or reverse, well, then it's going to break. Areas break all the time, typically with momentum. So this is what it looks like when an area breaks. Number 1, price reaches resistance, triggers remain below. This is a termination condition. Your job is to say, I don't have a clear path. I don't have to hope that this area breaks. I can let it break. I'm going to wait for the reaction. Doing nothing is typically your best role here. Number 2 is what it looks like kind of in the middle of breaking. And this is a potential to break look. This is what we call a 50-50 look. 50% of your triggers, the small triggers, absolutely smash through that area. Give it 3 or 4 points. Get that moving average away from the line. And if it has odds favorable momentum, if there is separation between the small and the large triggers are still below the area, 50% above, 50% below. This area has the potential to break, but it's just potential. It's not broken yet. There's a lot of opportunity in these 50-50 looks. It'll probably be your most common trade, but they need to be managed assertively because you're void of the clear path. Rule number 2 isn't met. But once the small triggers break above and the large triggers break above both lines of each, resistance is considered to be broken. It goes to the rear view mirror and it becomes support. And your path is clear and rule number 2 is met. And with that momentum, you're going to go look for an entry. And your path will remain clear until you reach the next area. So do it again the other direction. Price reaches, triggers above, pump the brakes, wait for the reaction. Every line you reach will be a termination condition, at least for a moment. Odds favorable momentum, smalls below, large above. A lot of opportunity in this 50-50 look, but they must be managed assertively because the area is not broken yet. Smalls below, large below. Support becomes resistance. The path is now clear until you reach the next area. And guys, this is the same all day long. So let's take a look. Crude oil, just putting on a clinic here. Price reaches Fibonacci resistance and my triggers don't break. And there's a huge retracement all the way back to Fibonacci support. And look at this, my triggers remain above and that's where the market continues up. Smalls break through, but the large don't. Only the potential. The potential is not realized. It pushes down to Fibonacci support. The triggers remain above. No long trade, no short trade, back into a divergence high, no long trade. That's where the reversal happens. And I want to show you something about patterns. Patterns repeat themselves. All we're talking about is patterns. This particular pattern is today in, what is that, crude oil? From resistance to support to retesting resistance, creating a reversal. I probably do this 10 times a month because that's how often this pattern tends to repeat itself. Left side is today, right side is almost 5 years ago. From resistance to support, retest, create a pivot stop out, there's your reversal. From resistance to support, retest, create a pivot stop out, there's your reversal. So guys, we're learning patterns right now. That's how rules come to be. And the one pattern that you can bank on is that when price reaches one of those key areas and the triggers remain above, is that any trade taken into that area is more likely to lose than it is to win, which means that there's not an advantage there. There's not an edge there. This is an 11-hour span where 36 times termination conditions and the rules that you just learned kept you out of a loser. 6 times where the market created opportunity for profits. That's not bad. It takes a level of patience, but you know exactly where the market is likely to continue. You know exactly where the market is likely to stop, and you're going to incorporate that into your plan, and you're going to insist on having that clear path because you believe in the edge that it provides. And there will be times when your path isn't clear because the areas are stacked. Guys, this is 90% of your day. I got a handful of pictures from a gentleman over the weekend, probably a dozen. And I would say 7 of them were trades taken directly into termination conditions that stopped the market. Guys, when you trade into a line and the triggers are above it, as they are in here, the likelihood of success goes down. If you lose this trade, this is what we call avoidable losses. Avoidable losses mean that you chose to not have your advantages, and it means that that's money you didn't have to lose. And when you take these trades and you lose them, your great trades have to make up for them before they get to go into positive P&L. So this is 90% of your day. Just waiting. And it's okay to do nothing because the futures markets trade trillions. Every day is exchanged in the futures markets, billions an hour. You don't have to be in every move. Your highest chance of success comes from trading away from fibs, finding a way to profit, and then getting out when you reach trouble. So that's what we're focused on right now. We're focused on the large chart leading the way, giving us the advantage of momentum and giving us a clear path. Is everybody good on termination conditions? It really is a simple recipe. If price reaches an area and the triggers remain above support, below resistance, guys, just don't trade into it. Sit on your hands. And remember, we're talking about the best of the best right now. There might be times down the road where you take a chance, but as a brand new user, let's give yourself the highest chance of success so we can create a little confidence. So, rule number 1 on the large chart says strong triggers. When it's true, I have momentum. Rule number 2 says no termination conditions, and when it's true, I have a clear path. I'm now done with the large chart. I have the advantages that I need to look for the highest probability trend trade entry. So I have to turn my attention to the small chart. We're going to backpedal to termination conditions one time because this is the one pattern on a small chart that behaves as a termination condition. Remember that the large chart is one bar, slow moving, hard to see change. If you see 3 divergences, 3 cyan lines from a low, 3 magenta lines from a high, if you see 3 divergences in the same price range on that small chart, it may terminate the trend. Hey, good morning, Wayne. Good to see you. And all this is the small chart showing you change that you can't see on the large chart. So 3 divergences may terminate the trend. Becomes more powerful with weak triggers, more powerful still when the final pivot is higher than the previous, lower than the previous from a high. This is the only time, ladies and gentlemen, on a small chart where I refuse to take an entry. This is the only termination condition on a small chart. Spice, you say it's not an exact price though. Hit an area zone. Don't be a dick for a tick proverb. Spice, I've never heard that, but I love that. And unfortunately for HR, I'm going to work that into every classroom, I think. And what Spice is saying, guys, let me do this for you. I'm going to show you both sides of the coin on the areas, Spice. Fibonacci areas, red resistance, blue support. Guys, Fibonacci is just a measurement. It's a measurement taken from a high and a low. Every twist in the market, every pivot in the market, your software, when you open it, it goes back 10 days on every swing, every up, every down. And it does every Fibonacci extension, retracement that it can think to do. And it does it on 10 days back, and it does it on higher time frames and lower time frames. And it creates all of these tens of thousands of calculations. And this is what it looks like. It's thousands upon thousands upon thousands of Fibonacci calculations. And then the magic hits. I had no idea my brother was this smart. The algorithm runs and it finds out which lines are most important and which prices have the highest concentration of the most important Fibonacci levels. So what happens is that from all of these calculations, you get Fibonacci. And on your large chart, anytime you see one of these lines, understand that they come from thousands upon thousands of calculations. So you're absolutely right, Spice. If I'm a tick below, man, my area's hit, in my mind. Sometimes even 2 ticks if my small chart's showing me divergence or something like that. So absolutely, Fibonacci is an area. But let's talk about yellow 1-to-1s. Yellow 1-to-1s, ladies and gentlemen, are an exact price. And let me find the definition for you here. And I believe John Novak put a link to it. So the yellow 1-to-1s, Spice, are an exact price. They are taken from one swing in the market, from a low to a high or a high to a low, back to a low, and they project an exact 100% Fibonacci alternate. So when I'm talking about Yellow 1-to-1s, let me go back to the picture. When I'm talking about yellow 1-to-1s on my large chart, I'm understanding that these are more of an exact price. The same is true for divergence highs and lows. Divergence highs and lows are the exact price where the market pivoted and turned with a loss of momentum. And these lines become lines in the sand. And those are an exact price. So SPICE, when we're not going to be a dick for a tick, I love that. We're talking about Fibonacci. But when you're looking at divergence highs and lows, when you're looking at yellow 1-to-1s, it's all right to be a dick. Pardon my French. Absolutely. That was such a good question. And guys, I'm going to tell you right now that it's your questions that make this classroom great. I regurgitate the same information I've been regurgitating for 5 years, laying down a foundation. When you tell me what the challenges are, what the opportunities are, what the questions are in the learning process, you give me the opportunity to create clarity. And I can tell you in 5 years, I haven't stopped learning. I'm always learning something new. You should do the same. So, large chart has momentum. Large chart has a clear path. Small chart does not have 3 divergences in the same price range. Guys, let's find an entry. Your entry is precision. And your entry is so precise that you're going to use a limit order. You're going to wait for the market to come to you. And you're going to use the limit order to buy or sell that pullback that's created by the small crowd. Let me find the picture because I like the visual on this one. You're going to use a limit order to buy or sell the pullback, that retracement, that fight by the small crowd, and you're going to do it at an area, at a fib, at a midband, or a yellow 1-to-1. And that area needs to be inside of triggers because triggers will define the retracement zone. Areas will define the bounce. On your entry chart, areas define where the market is most likely to bounce and continue with the trend, the same way that on your large chart, areas define where the market may bounce and stop that trend. So, inside of triggers is a very key point, guys. Price returns to the large triggers. Price returns to the large triggers on both charts, on the small chart and the large chart. It's a regression of the mean, it's a moving average, and when price accelerates away, it tends to pull back. So on your entry chart, you'll have 5-1 large triggers. Those are native to the chart. You'll use them to establish momentum, and you'll have your 13-2 large triggers pulled over onto that small chart. These are called synthetic triggers. You know they're the synthetic because they have these little steps on them. From the top of the triggers to the bottom of the triggers, the large and the synthetic, guys, this defines where that retracement is most likely to push. This defines where the down is most likely to go. So when you're looking for entries, your areas need to be inside of this retracement zone. You can give yourself an advantage as a brand new user, best of the best, by insisting on favorable large triggers, because favorable large triggers mean that both the large and the synthetic are overlapping, one on top of the other. Think about 2 snakes riding piggyback. And when you have this look, there's the least amount of space where we anticipate the retracement to return. There's the least amount of space to put a fib, a midband, or a yellow 1-to-1 inside. This is the highest level of accuracy for brand new users, the best of the best. It's not the only look. This is the easiest look, and that's what we're talking about in the first hour, is the easiest look. Spice says when you get close to your target, you need to ask yourself, how much am I willing to give back to be right for price to hit your target, which might be the fib. Amen. So Spice, one of the things that's super common, and I see this all the time in new users, is they'll say, well, I need to make $400 on this trade, and they'll put their targets 4 or 5 ticks on the other side of fibs. The experienced users, you'll almost always see their exits 2 to 3 ticks before that key area because they understand the idea that it's an area. Great points this morning. Thanks. So let's go define our entry. And it all begins with the rules being met on the large chart. I can't stress this enough. When I have momentum and clear path, I have a market that is not only screaming in the direction of the trend, but there's not a darn thing in the way to create a bounce. And guys, that is a great feeling, and it is difficult to stop. So when my large chart rules are met, I'm going to turn my attention to the small chart. I've covered up the large chart because I don't need it anymore. The rules are met. Your small chart, which should be screaming north. You should have strong triggers. You can look, say, all right, there's my large, there's my synthetic, I've got some areas, but you need to wait for a reversal bar. A reversal bar signals the beginning of the pullback, where the market is most likely to push down with all of this upward force. We know that price tends to return to large triggers. I say it 100 times every day. I have large triggers and I have synthetic triggers. So from the highest line of the triggers to the lowest line of the triggers, this is where the market's most likely to retrace. And the tighter on top of one another they are, the smaller this area becomes. Now guys, I had a brilliant picture sent to me over the weekend where the reversal bar that I'm going to use to signal the beginning of the pullback already reached areas inside of triggers. We're going to go back and I'm going to show you that picture and we're going to talk about it a little bit. But once you get the reversal bar, I want you to understand this isn't your entry. This is where that push, that pullback is most likely to start. This is the fight from the small crowd, and you're just defining where that retracement is most likely to go. It's the areas inside of those triggers that are most likely to create the bounce. So you take that big square from the top to the bottom, and you're going to refine it and create a window of opportunity. So areas can be fibs, midbands, or yellow 1-to-1s inside of triggers. This box from the highest area inside of triggers to the lowest area inside of triggers shows me where the market is most likely to bounce in the direction of the trend. Guys, I've got this little rule in my head, and it's not an official rule, is that if my reversal bar, the one that tells me to look for my entry points, that tells me to look for my retracement point, if my reversal bar gets below the triggers, hits an area, I'm not typically looking for that area. This is a momentum style trade look. A trend trade, more often than not, is going to have 5 to 7 bars pulling back. And there's going to be times where it's blurred, where you're like, oh man, this could be a trend trade, this could be a momentum trade. I want you to understand that it's not wrong, either one. If you're always using the language, the definition of entry becomes easy. If you're always saying an area inside of triggers, if that language matches the look, you have a trend trade. So these are my areas. These are most likely to create the bounce. This is where the small crowd is most likely to fail. Your job is to develop the trust to put a limit order just above the area inside of triggers. So if that reversal bar hits the areas, it's going to be difficult to put a limit order at the area. Guys, this is it. This is what it looks like before you enter a high probability trend trade. You have strong triggers on the large chart. You have nothing in the way on the large chart. You've defined where the market is most likely to bounce on the small chart. You've done all you can do. Now you just need the market to give you an entry right at that limit order. And if they push down and they hit your limit order, guess what? You're in a trade with every advantage. This is the best of the best, the highest probability trend trade, the one that typically wins 70 to 80% of the time. This is your best case scenario, optimizing your chances of success as a brand new user. All we've talked about for 30 minutes is how to pinpoint that area. That's it. We haven't talked about management. We haven't talked about any other trades. We've just laid the foundation. So learn this. Even if you don't want to be a trend trader, Learn how to identify momentum on the large chart. Learn how to define your clear path on the large chart. Learn how to wait for the reversal bar. Understand that when the reversal bar prints, it's most likely to close back to those triggers. Know that it's the areas inside of the triggers that are most likely to create the bounce. Know that your limit order, because of large chart advantages, goes 2 ticks above that highest point of support. And the cool thing is that if triggers define the retracement and areas define the most likely bounce, you'll begin to understand that anything below those triggers, on the wrong side of those triggers, is not a part of that window where we expect the small crowd failure, where we expect trend continuation. This is what we call the wrong side of the triggers. And the wrong side of the triggers is where the market should not go if we're going to retain that advantage through rule number 3. Reversal bar starts the pullback. Define the retracement zone with triggers. Define the bounce spot with areas. Anything on the wrong side of the triggers, above those triggers for a short trade, is where the market should not go. You're going to use that idea because that's going to define your first stop. Your initial stop placement will be 4 to 5 ticks beyond those trigger lines, exactly where the market should not go. And if the small crowd, if the market can push through the triggers, the retracement zone, if the small crowd can push through the areas inside of triggers, the bounce spot, and get 4 or 5 ticks beyond those trigger lines, guys, my advantage is gone. This is my stop placement. And 20 to 30% of the time, the market's going to smack right into that. 20 to 30% of the time, I'm going to take a loser. And guys, losers are not a negative when you follow the rules. Losers are a part of doing business. They're a normal part of a positive equity curve. So 4 to 5 ticks above the triggers, 4 to 5 ticks below the triggers, guys. This is where the market should not go. And Spice, before I even read the rest of your note, I do not make recommendations. I do not give trading advice in this room. Do you recommend that new users wait for a confirmation bar before entering a trade, realizing that you are giving up some points versus getting into the trade at the better price? So Spice, you're asking me, Mark, if you know without question, because you studied it, you practiced it, you verified it, you made sure that it was true, if you know hands down that when you have the advantage of momentum with strong triggers, that you have a clear path because there's no termination conditions, and because dang it all to heck, you know exactly where the market is most likely to continue because there's areas inside of favorable large triggers, and that entry 2 ticks below that area or 2 ticks above that area is the highest probability of success. Mark, does it make sense to give up 8 ticks on a confirmation bar? Spice, I think no. I think it's ridiculous to wait for confirmation when your rules are met, because your rules have been proven to win more than they lose. Does that make sense? And that's exactly where I was going with this. And Spice, I think you led the witness. You knew exactly what you were doing. Not your first rodeo. Guys, I'm going to show you a couple different entries. The best entry is always, without question, the pullback to the area inside of favorable large triggers. This is the one that is going to provide the least amount of risk if your stop goes 4 to 5 ticks below. Does that make sense? And then I'm going to show you something. I know you were, Spice. I know you are. I appreciate it too. Don't think that I don't. Guys, it takes courage to buy a market on the way down. It takes trust to buy a market on the way down. So what Spice was saying is, man, if you're a brand new user, why don't you just force the market to give you an up bar? Get a little confirmation. And you're sacrificing 4, 5, 6 ticks for that confirmation. But what it does is it will create a little more confidence in the new user, saying everything's set up, the momentum is strong, the path is clear. I'm terrified to buy it on the way down. I'm going to buy it on the way up. Does that make sense, everybody? Confirmation bar. It is my personal opinion and not at all trading advice that when the rules are met perfectly, you can't keep me from taking that great entry. But let's say perhaps my rules are met perfectly on the large chart, but my small chart has a huge window because maybe the large and synthetic are separated from one another. Or maybe my area is just on the wrong side of those triggers. Is there anything wrong with saying to yourself, my rules aren't perfectly met, I'm going to force confirmation before I enter that trade. I'm going to force the market to go in the direction of the trend of the momentum of the clear path before I enter it. And guys, there's a million ways to use the software. But once you can define this window, get in. Whatever makes you happy, because you know exactly where your stops go. And don't panic. Well, Spice, I'm not sure what you mean by that. But I'm going to tell you, once I get to the wrong side of these triggers, rule number 3 advantage is out the window. And I don't know where the market's going to stop or if it's going to stop. That's my 2 cents. Guys, this is how you're going to study it. When your large chart has momentum, when your large chart has path, you're going to see those tails. Guys, these tails are not your entry. By the time that tail forms, the market's gone. You're making the decision to enter all the way up here. You are literally 8 ticks from trouble. 8 ticks from that divergence high that could stop the market. But if you trade from the area inside of favorable large triggers, that 8 ticks becomes 30 ticks, $300 worth of profit. Your risk goes down exponentially. Your profit potential grows exponentially. Guys, if you circle the tail on a large chart when the rules are met, this is your study tool. Let's see if we can find one. Holiday trading. Just for grins, because this one may do it even without the rules. Actually, it won't. If you circle a tail on the large chart and it pulls back to support inside of triggers, the rules are met, that could be your look. That could be your entry. Let's see if the S&P had one. I'm looking for an actual entry, not a pretend make it up entry. This is probably a pretty good look right here. Let's see. Strong triggers, smalls above the large, large above the areas. Let's go see what this looked like on a smaller, faster chart. And guys, this isn't a trade. I'm going back historically. I'm not trying to trade in the moment. I'm going back just looking to recognize a pattern. And there it is. It never gets below the triggers. It bounces off the areas inside of the triggers. It's right in the retracement zone, and the retracement zone isn't perfect. Spice, this might be one of those times where you say, you know what? I'll force a confirmation bar to take that trade. Kind of cool, right? So it's just a pattern, guys. That's all it is. So let's talk about how do I start to recognize these patterns. New users, this is what I don't want you to skip. Because I believe 100% without hesitation, all the conviction that I can muster. If you go through this chart reading 101 exercise, you're not going to make mistakes on whether or not you have advantages. So the goal for all of you is that you first look at your large chart and identify momentum and path. This is the core, guys. This is the foundation. And understanding these 2 concepts are going to open the door for all the other trades. Take 25 pictures each of strong triggers and weak triggers and know the difference. Take 25 pictures each of a clear path and a termination condition and know the difference. But not just taking the pictures. Take time to annotate your chart, to write on that chart. So if I take a picture of a strong trigger, I want to write that the colors match. And I want to write that the smalls are above the large or that the smalls are below the large. I want to write on that chart strong triggers, odds favorable momentum, rule number 1 met. And then I want to take that picture for each of those concepts, and I'm going to go back to the basic rules. Because if I click on this picture labeled strong triggers, smalls above large, space between, momentum, rule number 1. This is always my look. This will always be my look. This is always strong triggers, guys. And if you go through and you commit that to memory and you create the recognition between what you see and what it means to you, well, then you're never going to make the mistake of believing that the smalls inside of the large weakness, anything can happen, is an advantage. And you won't begin to expect and hope the market to go up. You'll understand that this is what it looks like when bigger retracements happen, when key Fibonacci areas tend to hold the market more. So go through that process. Take the pictures, post them in the spreadsheet. Commit 3 or 4 minutes of your day to doing 3 or 4 pictures a day until it becomes second nature to understand path and momentum. And then as you're doing that, I don't want you to feel like I'm just sending you out into the wild. Here's what it looks like. This page is called the High Probability Trend Trade Checklist. It has a checklist to put you into the highest probability, best of the best, optimize your chances of success, high probability trend trade. And that one comes from a strong top or bottom, from a termination, no triggers through, that reverses the market. It's not mandatory to have this look, but there's a boatload of warm fuzzies that come from it. Do I have momentum? And this says on both charts, separation, strength. That's weakness, always. No termination conditions. And if you know the difference, and you can say the difference out loud when you look at your chart between a termination condition, when it's only potential, or if the path is actually clear, understanding whether or not that rule number 2 advantage in there is going to let you know whether or not it needs to be managed assertively, whether you can actually call it high probability, or if it's really a medium probability. And then defining your entry points, knowing where to put it. Guys, all of this is given to you. And the second page is a checklist for you to print out, to put on your desktop, to police yourself every time you're looking for a trade. And even more importantly, to write these rules on your chart, every trade. And you'll never ask me, hey, was this a good entry? You'll tell me, Mark, this one fit the list. Even though it didn't win, I know that it was more likely to win than lose because I've studied this. So I'm going to give you this as well. And then I'm going to give you this bad boy. This is the KISS plan. And the KISS plan is a stepping stone in your learning journey. The KISS plan is the one that teaches you to read your indicators. The KISS plan is the plan that sets you up to find the other trades. The KISS plan is designed to optimize your chances of success with the high probability trend trade as a new user. And then through simulation, study, class feedback, and continuous practice, you'll be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators. Exactly what Spice just said. You'll become a chart reader, and you'll understand where the market is likely to go, where it's likely to stop, and where it's likely to continue. There's 2 things that you have to know before you sit down to trade and you're not on simulator. And guys, I put not on simulator for a reason, because on simulator, I want you to screw everything up. I want you to make every mistake, because we're going to teach you how to avoid it. And I don't know that you're making these mistakes if you don't post in the room. So you need to know why you're going to enter a trade. Guys, rules are nothing more than a description of a pattern that has been proven to win more than it loses. So your rules are the description of a specific pattern. The high probability trend trade is a specific pattern that wins more than it loses. And if you verify and trust this pattern, guys, there's no reason to not consistently enter when your rules are true. Your rules will eliminate and help to eliminate the emotion in trading. If you believe in the pattern and you know that it wins more than it loses, guys, you don't have to know whether it's going to win or lose. You don't have to know what's going to happen next. You have to know why you will exit a trade. We haven't even talked about exiting a trade yet, guys. Exits are taken either at profit targets, and you're going to be able to intelligently put some profit targets in there, understanding where the market is likely to go, or when the advantages that had you get into the trade have gone away. Three divergences in the same price range is an outstanding example of that. If I enter the highest probability trend trade and a three divergences print before it hits my target, that's my cue to jump ship. So we've spent an hour defining entry, just getting into the market. And then once you define your entry, once you enter the market, guys, this is where most people, brand new users, this is where their palms start to sweat a lot. This is where they get butterflies in their stomach. This is where the fear of losing kicks in for a lot of people. So for a brand new user, for someone just learning to read their indicators, your management plan should be just as if then, just as pragmatic, just as flowcharty as your entry. So this management plan is based on 2 contracts, getting into the market with 2 contracts. And KISS management is designed to help you understand and trust stop placement, as well as being focused on getting profits captured quickly. Guys, we're teaching you how to protect yourself and how to get paid quick, because let's face it, getting paid is the goal of trading. And then there's that darn phrase again. You'll craft a plan tailored to your personal goals based on your experience reading the indicators. This is not the only way to manage a trade. This is the highest probability, get you paid the quickest, lose the least way to manage that highest probability, best chance of success trend trade. And your initial stop will always be where the market should not go. So if your entry is 2 ticks below resistance inside of triggers, guys, using that language, area inside of triggers, then your initial stop is 4 to 5 ticks beyond the triggers, where the market shouldn't go. And as long as it's in that potential to retrace zone, I don't panic. That's that deeper retracement Spice was talking about. Spice, I like having you in here. But if it goes 4 to 5 ticks beyond that retracement zone, if the market was able to blow through those areas, most likely to create a bounce, guys, that's where the market shouldn't go. That's my first stop. And the great thing about this methodology is you'll know exactly what your risk is before you ever enter the trade, and you can make the decision on whether or not you're willing to risk that. If you're not willing to put 15 ticks of risk on this particular trade, this is not your trade. Putting your stop inside of triggers where you feel comfortable with the loss is more likely to get hit than not. Targets will be predefined at $100 and $200 with the KISS plan. If your stop isn't hit, you're going to get that confirmation bar, that reversal bar, that bar in the direction of your trade. And if a reversal bar prints in the direction of your trade, you're going to redefine where the market should not go. And guys, your new stop is 2 ticks above that reversal bar. If it's a long trade, 2 ticks below. So now you have $30 of risk in this trade. You had $150 per contract. Now you have $30 per contract because of the precision and the advantages. And guys, losing $30 per contract does not impede forward progress very much. And at this point, you're either going to get stopped out for $30 per contract. It's a normal part of a positive equity curve. Your methodology reduced your risk dramatically. Or it's going to go to your first target. These are predetermined. And I want you guys, if you're brand new, to learn how to let these things play out. Avoid the temptation of moving your stops and targets. Just let it play out. You're on simulator. You've got nothing to lose and everything to gain through the lessons. If price reaches your first target, 1 contract is automatically removed, and those funds go into your account, simulated or otherwise. And with 1 contract remaining in the trade, guys, you're going to move your stop to break even. You will have no risk on the trade, and profits have been taken. Your palms aren't as sweaty. That little bit of success is breeding confidence, and you have absolutely nothing to risk. And guys, the whole reason we do that in the KISS plan isn't because it's your best option. It's because your large chart should have odds favorable momentum with absolutely nothing in the way. And all you're doing is developing a little bit of trust to hold for the second target. If you're not stopped out break even, and and it goes to your second target at $200, predetermined. That's a $300 trade. That is 4 minutes of your life, all the advantages. That's a $300 trade. And I built this because I want to remind you new users, you don't have to make $1,000 a trade to be a successful trader. $300 a day, if that's the best you do, and your account doesn't know if it was three $100 trades or if it was one $300 trade. Your account has no idea. $300 a day times 252 trading days in a year is a $75,000 a year. Guys, I've talked to my salesmen a lot, and they're like, oh, we're going to show them the potential to make $500 a day. Guys, if you see the potential to make $150 a contract a day, that's 75 grand. Think about it. That's a lot of money. Throw in a break-even trade, go to 6 figures. Guys, the whole idea is that you're reaching your profits daily through the best of the best. Not taking all the trades, but taking the best trades. And it's those daily profits consistently reached. That's what gets to your long-term goal. And as you grow and you learn and you understand more, guys, the potential for more and more and more, for higher reward becomes evident. And then you start using those trade copiers, right? And you make $100 a day on 10 contract or 10 accounts copied. And suddenly that's $250,000 from only capturing $100 a day. So the goal is that you learn how to read the indicators. The goal is that you learn how to capture the best money and let that carry you over to the rest of the lessons. So the final thing, actually, you know what, before I do this, I'm going to go back and I'm going to just reiterate where we've been, and I'm going to give you everything real quick. We learned the rules for when it's okay to trade, right? What does that mean, Mark, when it's okay to trade? If the rules are met, if I have the 3 advantages, I'll enter the trade. If my advantages aren't present, I'll choose to not trade. Pretty easy, right? Almost too simple, I think. You guys have the ability to simulate. And more so, you have the ability to take a picture, to drop it in the room, to get feedback on everything that you do. You have a spreadsheet where you can put all these pictures and go back and study them. You now have the chart reading 101, so you know how to get to where you want to be the absolute fastest as a chart reader. You have a KISS plan, optimizing your chances of success with the high probability trend trade. The second page of the KISS plan is that 50-50 look. You've got the spreadsheet was dropped in the room. I'm going to drop it again right now. And then I'm giving you a zip file with everything that I've just given you. All of those study guides, all of those study tips, that KISS plan, even the PowerPoint that I used to teach the room, guys, you now have everything that you need to be successful with this software. The only thing that Nexgen can't provide, the only thing that I can't give you is experience, is repetition, is the desire to do the work, to learn these basics and then let them work their way into another trading plan, your trading plan. So let me go to the last thing that I do, and I do this every day before I start the second hour, because this is important. The key to everything that we do, and I'm talking to my new users, the key to everything that we do is having that foundation, being able to look at your chart and speak out loud to yourself on the advantages that you have or do not have, so you know when the edge, when the advantage is in place and it's time to take a trade. And then every day, you're going to compound a little bit. You're going to grow a little bit. You're going to get a little bit better each and every day. So for you brand new users, I blanket you with very conservative rules. I know that I do. I talk heavily about being able to recognize advantages, to saying them out loud before you ever take a trade. And I hand you a solid plan that optimizes your chances of success as a brand new user as you learn to read your indicators. So for you new users, it's going to feel like all termination conditions are bad, no momentum is horrible, no areas inside of triggers is detrimental, guys. And these blanket rules are in place because it increases the likelihood of success for you. Because when you follow these advantages, you're more likely to win than lose. And that success creates the confidence you need to grow with the software. They're not always bad, but until you have the repetition and the experience to know when to use exceptions, guys, it's just safer that way. And then just like anything, the more time you spend with it, the more you will see. And this opens doors for you. So the process yields the results, and then the results seem to follow. And this is an important thing. Trading has nothing to do with your hopes. The market couldn't care less about your position, couldn't care less about your mortgage. The market doesn't care that you think it should go up. It's the process. It's the pattern that's been proven to win more than it loses. That's where the successful traders get their success. This is where the KISS plan comes in. If you can keep it that basic, if you can keep it this simple, and if you're okay not looking for all the trades, and I say this as we go into the second hour, because you're going to see traders taking trades that are not high probability trend trades. These are traders that have created a plan based on their ability reading the indicators. But if you keep it simple, you can find an extraordinary level of success, and I've watched it repeatedly over the last 5 years. The further new users deviate from simple, the longer they tend to take to learn how to be comfortable with pattern recognition, to be comfortable with management. So question everything. I mean everything. If you're wondering about something, don't sit there and wonder, guys. Put it in the room. I want you to learn, but I also want you to give yourself a little grace. You are new, and it's okay to be. It's all right to be new. So, guys, everything that I do in the second hour, every picture that I look at, I don't even know if I have a picture in the room because the market's not doing a damn thing. Every picture that I look at in the second hour always goes back to momentum, path, and entry, because I firmly believe that once you understand momentum and path, it opens doors for you. So don't be the trade police. Take a lesson off everything. And I want to show you, I did this morning. These are the most common trades that you're going to see in this room, guys. And this is just a little glimpse of what's available to you when you learn to read your indicators. More than anything, termination conditions hold. That strong top or bottom sets up at least 3 trades that require that termination. There's the white bar breakout trade. This is advanced from John Novak, uses a market flow chart, happens right at the bottom. There's an HVA long. Nexgen's been teaching this forever. There's a momentum style trade. This has been part of the core for Nexgen for 20 years. And then, guys, there's your easy one, that trend trade that happens in between the areas with momentum. And then you're going to see some people take what's called a chili dog trade. And this was developed by a Nexgen user, and it relies 100% on momentum and path. And then you're going to know to stop trading at the next termination. I made this morning, and I thought it was kind of cool. And I want to remind you that it's the foundation that you create that's going to open the doors for the rest of these trades. But if you try to catch every one of these trades as a new user, you're going to confuse rules on both entry and management, and it's going to be harder for you to find the best of the best, the one that yields the highest results. So I'm going to take 5 minutes. I'm going to take a break. I'm going to bounce around. Guys, this is the S&P. This is all the S&P has done today. And it looks like it is just 100% stuck in the mud. Price reach support, all the triggers are above. Guys, there is no pullback to areas inside of favorable large triggers without that clear path. Crude oil hasn't done much more, guys. We are 3 hours into the day, and that's it. That's all it's done. And obviously, there's no pictures in the room. Nobody has posted one trade today. So here's what we're going to do. I'm going to take 5 minutes. When I come back, I'm going to answer any questions that you guys have. And then we'll probably call it early today. So go stretch your legs real quick. Gary 416, if you have any questions, I know you're newer, drop them in the room. Trent, same thing. You just got a lot of feedback. I'm assuming it's the same, Trent. If you have any questions on it, great time to drop it in the room. Get some feedback. If you're working on a new trade, if you're working on a new pattern, if you're focused on different management things, guys, throw it in the room. Let's talk about it. I'll see you in about 5 minutes. Going to be an early class, so I'm just going to come back and we're going to get going. I wanted to revisit this picture. Whoops. And I wanted to try and turn this into a lesson for everybody. So this picture was sent in. So Spice, they're not really supporting 7 a whole lot anymore. There's still users that use NinjaTrader 7. NinjaTrader 8 does have a couple challenges here and there. There's no doubt about it. Most people you'll find are on NinjaTrader 8, and John's programmers are probably 95% done with the Nexgen browser version, which is going to give you 100% of the functionality of NinjaTrader 8 that you'll be able to sit and trade from your iPad on the beach. We're excited about that one. Should be up pretty soon. So guys, I want to talk about this trade because there's going to be times where the lines are blurred a little bit. And this is a great example of it. Wayne had momentum. Whoops. So on this chart, the momentum was cranking. The path is clear. His range chart says up, let's go. And he gets a tiny little, it's a 1 bar snapback to a fib. And there's 2 ways to look at this. One, the fib is in fact in the retracement zone. So you could say without a doubt, it fits the rules for a trend trade. Does that make sense, everybody? Pulled back to a fib right inside of the retracement zone. That fits the rules for a trend trade. The second thing is your reversal bar got to the other side of the synthetic triggers, which means that you're already through the first correction point. The area is there without a doubt, and it's the highest level of support, and it makes sense to take that trade. If this trade fails, if this entry doesn't create the bounce, as long as you remember that there is a second lower area inside of triggers that the market may go to, that is more of a trend trade with a bigger retracement. And the first entry, while it fits the trend trade rules, is what we call a momentum trade. Using momentum, and you're really anticipating the break of an area, and it creates this little snapback right here, right to the fib. And this is a very low risk momentum style entry. If this trade fails, it's likely to pull deeper and create the trend trade. But there will be times where you're like, man, how do I define this trade? Do I define it as a momentum trade? Do I define it as a trend trade? Because it creates different expectations. A momentum trade, you hold it until the momentum is gone. A trend trade, very often the next area is the target. So you have to make the decision. Am I willing to exit that trade with a loss of momentum? What about the market being past synth triggers? Okay, so Kurt, you're saying you're on the wrong side of the synthetics, right? So let's go through the very basic language, Kurt. When the reversal bar prints, right? And this is why this is one of those blur the line trades, guys. This is not the best look. It may go anywhere from the top of the triggers to the bottom of the triggers, and Wayne put that in there perfectly. So Wayne defined where the retracement may happen. And it doesn't say that it's synth above large or large above synth. The only thing the triggers are used for is to define where the retracement is most likely to occur. Does that make sense? So even though it's through one area, it's still not through the other area. This right here defines that danger zone. And anything below that danger zone, that's where we don't want the market to go. So anything bouncy in there, absolutely, you're still good. It's my opinion, and guys, this isn't a rule. This is just a little bit of experience. If my reversal bar dissects the Fibonacci area and the retracement zone. This one didn't. This one created a bounce right off of it. But if my reversal bar dissects an area, I kind of take that one out of the equation and I start looking for the one lower. Because if it didn't create the bounce, how's it going to create the bounce if the bottom of the reversal bar is below it? I'll try to find it. Let me see if I can find a picture of what I mean there. This is a good example. If the reversal bar dissects an area, I don't consider that area to be a part of the equation. I start looking to the next areas. Does that make sense, everybody? So if my reversal bar dissects that fib inside of triggers, I automatically look for the next area. Because this area can't create a bounce if the top of the bar is already on the other side of it. I hope that makes sense. It dissects resistance. There's your momentum style trade off of the one-to-ones. When the momentum style trade doesn't work, it turns right into a trend trade. Kind of cool. So that's a little more advanced, but Wayne's picture was pretty awesome, and I wanted to share that. All right, so Gary, two things here. First of all, three divergences, same color, absolutely. Recognizing that small chart termination condition. But when your charts look like this, and your triggers seem wonky and crazy, guys, this is a Monday morning occurrence. I don't know why it happens, but it does. Gary, do me a favor. Right-click on either one of your charts and go and reload all historical data. And what that's going to do is it's going to kind of set you up because I guess it's NinjaTrader. Over the weekend, there's this stop in data when the market's closed, and then when you reopen it, you kind of have to rerun it or reload your Ninja script to get things looking normal again. I have to do it every morning. Let me see if I can. I haven't opened a gold workspace in a month. I'm going to open up a gold workspace and let's see if it gives me that little wonkiness that you see on a Monday every now and then. And it probably won't because I'm trying to build a lesson here. We'll wait for the small crowd or the small chart to come together. Okay, it did fix it for you? Okay. And of course this didn't come up and do what I needed it to do. Even gold's not doing a whole lot in there, but check this out. Let's see if we can see a gold pattern while we're doing it. But Gary, you were spot on. 3 divergences in the same price range, even with those crazy looking charts, was right. And then here we go. There's your pattern, guys. Odds favorable momentum. Didn't reach the area, cleared the previous area, reversal bar, and it comes right back to the mid-band in the retracement zone, and the market continues down. You guys want to go through an entry, like a bar-by-bar entry? Because why not? We've got nothing but time, right? All right, so let's start on the large chart. Hey guys, this is what I want you to do. Every time you're looking to take a trade, I want you to ask yourself, do I have momentum? Do I have momentum? Do I have strong triggers? Are the smalls below the large? Are the large wide? Is there space? Absolutely. Rule number 1's met. And then I ask myself, do I have a clear path? And guys, every time I look for a clear path, I do 2 things. Did price reach an area? The answer is no, which means that there's nothing in front of me. But did I get past the areas above me? And my small triggers are through, but my large triggers are not. So give me a Y if you can see that this particular look is what we call, this is what we call a 50-50 look. 50% of my triggers are through, 50% are not. And the only thing I want you guys to get out of this is that now I have the potential, might need to manage. That's it. Does that make sense? When you speak to yourself in terms of advantages, you know what you're up against. And if you know what you're up against, you know that you may need to manage. But guys, this is a giddy up, and it's coming from a termination. See the fib? None of the triggers break. This is beautiful. Let's look for an entry. Look at that small chart. It is absolutely screaming down. Does anyone remember, what are we waiting for on this small chart? As it goes down and your guts start to twist and you're afraid, oh my gosh, I'm never going to get an entry. I'm never going to be able to get this. I need that small crowd to fight, guys. I need to wait for a reversal bar. Everybody with me so far? The reversal bar signals the beginning of the pullback. The reversal bar lets me know that the fight is on. At the time of the reversal bar, this is not my entry. I'm going to do 2 things. First, I'm going to define where the retracement is most likely to occur. Somewhere from the bottom of the trigger lines to the top of the trigger lines. What am I doing? I'm defining. This is where the next set of up bars are most likely to return. Not my entry, guys. Trigger lines are not my entry. Watch how much smaller this box gets. From the lowest point of resistance inside of triggers to the highest point of resistance inside of triggers. And guys, this box represents where the market is most likely to continue in the direction of the trend, where the market is most likely to continue in the direction of the momentum, where the market is most likely to continue off to the next area. Your job is going to be to right click on that chart. Oops, it's not going to let me because I don't have an account. There we go. And put a sell limit 2 ticks below that lowest point of resistance. And at this point, guys, there's nothing else to do. You've established momentum, the potential to break. You've pinpointed where the market is most likely to continue. And now you're waiting to see if the small crowd has it in them to push up to you. Is everybody with me so far? Notice that the large chart hasn't changed. Well, here comes the market. That mid band's getting a little lower. It's okay to lead your shot. So look at this. I'm 4 bars, 5 bars, 6 bars, 7 bars into a retracement, and my large chart hasn't blinked. Every advantage that I was relying on from the large chart is still in play. Guys, this is my entry. 29.14.10. 0.1, however you want to say it. This is my entry, 2 ticks below resistance in the retracement zone. And my initial stop, guys, you can either love it or hate it, is up here where the market shouldn't go. That's a lot of risk. That's $190 worth of risk, almost $200 of risk on the potential to break. Does that make sense? Some of you will say, yes, I'll take it all day. Some of you say, you know what, I don't care for it. I don't care for that level of risk. Not on a potential to break trade. If that's the case, this isn't your entry. Let me show you where your entry can be. When the entry or when the risk is too high, Kurt says I'd wait for a confirmation bar. Let's go to the next bar. Uh-oh, we're getting run over. Oh, crap, they're taking our money. Boom. Kurt says, you know what? I'll take the confirmation bar, Mark. I'll force the market to go down, and I'm willing to give up 7 ticks for confirmation. But what did that do for Kurt? He went from $200 of risk to $120. And now he has momentum, the potential to break, and a market that's moving in the direction of the trend. And guys, this is what Spice was talking about earlier. Should new users wait for a confirmation bar? I'll never tell you if the rules are meant to wait for a confirmation bar. But if it makes you feel better, do it. All right, we're in at 13.4. Where's our first target? Our first target would be at 12.4. We'll make this green because green is money, right? Remember that our targets are predefined. So there's our first one. And there's our second one. Guys, notice how the second target's on the other side of an area that may stop the market? Every now and then you may say to yourself, I'd rather get out of trouble instead of insisting on a $300 trade. That's up to you. But let's see how this one plays out. Starts heading down. Oh, you know what? 14.1. No, we got in at 13.4. So there's your first target from the confirmation entry. You're $100 and now you're break even. Guys, if you took the best entry, you were already $100 up right here, and you're 3 ticks away from your $200. So there is a definite cost for confirmation. Let's see what happens. Boom, boom, boom. So there is our yellow 1-to-1 if we chose to get out of trouble, because the market didn't get to the other side of that 1-to-1 before it bounced. The market didn't get to where the confirmation target would have been. But the great entry created a $300 trade. Pretty cool, right? Does that make sense, everybody, what we just did there? That's just bar by bar. The cool thing is you guys can do this on your own if you want. And so for you new users, look at this. The area most likely to create a bounce happens to be the very top of that tail on the large chart. That's your pattern. And if you learn to trust the best entry, that was a $300 trade per the KISS plan. Pretty awesome. So guys, one of the things you can do is you can go through and you can look for these tails. Let's circle this tail with odds favorable, momentum, and clear path. Oh my gosh, right to an area of support inside of triggers. Gary, do you see it? Trent, do you see it? This is the one pattern. This is the one thing that I want you guys to learn, because once you understand this, it opens all the other doors. So many people want to skip this very basic trade because they don't want to wait that long, because they'd rather be active. Once you learn this look, it's pretty cool. And let me address the elephant in the room here. Gary, I bet you were saying, but Mark, it's 3 divergences. You can't take that trade, right? Because I know that you're in tune with that. Let me show you something cool. You guys remember the rule that when the smalls and large get above an area, the area is considered broken? That's the line from the divergences. Small and large got above it. We are right back to our first divergence. Once small and large got above these, the count resets, guys. It's that same idea of termination conditions. When the small and large break it, there it is. So I would hope that you guys would scroll back a little bit. There's the potential to break with all that momentum. Let's go see what it looks like. Multiple areas of support right inside of the retracement zone. And that's one of the reasons why I want you guys to define where the retracement is most likely to occur, and then where are the areas inside of that retracement. I've never heard that phrase, Spice. Honestly, I've never heard that phrase, repairing divergence. For me, it just means that it's broken. And anytime something is broken, I don't worry about it. Once my smalls and large broke that area, John used it a few times. Okay. I wasn't there when he did. I've never heard it. He's never used it with me. But it makes sense when you say repairing divergence, right? So there was a loss of momentum. There was a loss of momentum. And when the smalls and large got above it, it repaired that loss of momentum and put you back into a better position. I like it. It makes sense. I've just never heard it. You're giving me a lot of new phrases to work with today, Spice. Guys, the S&P has taken 20 minutes. Actually, no. It is 10:47. That is an hour on the S&P. I love that you guys are here today. I love that you guys are here today. I'm going to kick you out. I want you to go live your lives. Unless there's questions. Guys, if you have questions, I'll stick till noon. But I am going to end the broadcast for YouTube